Thank you for coming to today's event. This is the second Government and Policy Club event. We're very glad to have Professor Kroszner and here. This is working? Okay. My name is Richard Day. I'm one of the co-chairs of the club. If you haven't signed up yet, especially if you're a first year, we'd love to have you. Next week we have Sadie Stockdale Jefferson, the Deputy Chief of Staff of Chicago Public Schools, coming to talk. Today's event is being live streamed, and so it's being recorded. It is on the record. Particular thanks to our partners at the Stigler Center and the Harris Center for Economic Policy for helping put on this event today. We're very happy to have all of those other guests with us. But today I'm particularly excited to introduce Professor Kroszner, our guest, who is the Dean for Executive Programs here at Chicago Booth and a professor of economics. From 2006 to 2009, he was a member of the Federal Reserve Board of Governors. From 2001 to 2003, he was a member of the President's Council on Economic Advisors. Our moderator for today's event is Adam Creighton. He's the economics editor for The Australian. He spent 2016 as a journal writing for the Wall Street Journal. In 2015, he won the Citi Prize for Journalism Excellence. We'll spend about 35 minutes with questions from Adam, poking around a couple of key issues looking towards 2020. Then we'll open it up for questions and end around 1:10. With that, please join me in thanking Adam and Professor Kroszner.
Okay, well, thank you very much, Richard. And Randy, it's a real pleasure to be able to interview you today. Look, I guess on the minds of all of the presidential aspirants, I suppose, for 2020 would be the state of the US economy, of course, in 2020, and whether or not this extraordinarily long expansion that the US is currently in, I think it's actually coming up for the longest ever, whether it will die out or not. And so my first question, I guess, is basically what do you think the chances are of the US remaining robust towards the end of 2020?
Yeah, this is, of course, the question of the crystal ball, which is always a little bit cloudy, and especially with such turbulent times. So we're getting mixed signals right now. So if you look at the data, at least for the U.S. economy, first quarter GDP was pretty strong. Second quarter GDP is on track to be about sort of 1.5 or so. First quarter GDP was a little bit more than 3, so we're probably averaging in low twos, which is still pretty robust given how long, as you said, how long the growth phase has been. But we're seeing some, at least for me, some concerning signals in the market. The interest rates are really going down quite a bit. The longer rates are heading down. Now, there are a number of things that could be driving that. It could be markets are concerned that there's going to be very little demand for investment, and so longer rates are heading down because of that. It could be because they're concerned that we may be having very low inflation or even getting into deflation state. Because this is not unique to the U.S. Interest rates, longer rates around the world are coming down over the last few weeks, and so the data, sort of the macroeconomic data, seem to be quite sound. The labor force participation has started to move up. Unemployment rate very low. As I mentioned, GDP growth seemed to be on a pretty solid footing. But a few concerns about how the markets are perceiving some of the risks. And so I'm generally an optimistic person. And when we did the economic outlooks back in January, when everyone was concerned that the economy was going off the cliff, I said very clearly I didn't think it was. The data were not suggestive of that. But I'm becoming a little bit more concerned that there could be a slowdown in 2020. And that's going to be a real challenge, not only for the U.S., but for the world.
Mm-hmm. Yeah, you just mentioned those long-term rates there. The 10-year rate, I think, has dropped from 3.2 late last year, 3.2% to something like 2.2% recently, which is an extraordinary change. Certainly in the past, a low long-term rate is often a sign of a slowing economy, but because of the vast interventions of central banks around the world, including the Federal Reserve, can we rely as much on these market signals anymore in the bond market?
Yeah, I think, well, there are two things. One is the inverted yield curve. That is when the short rate is higher than the long rate. That always happens before a downturn, but it also happens at other times. So the joke is that it predicts 7 of the last 4 recessions. And so it's necessary but not sufficient, it seems. But exactly as you were saying, Adam, interest rates have been relatively low, yield curves have been relatively flat, inflation expectations have been quite muted. And so in that circumstance, the long rate is not going to be that much above the short rate. So one of the reasons the long rate is above the short rate is because people are worried about inflation over time, and usually inflation, if we look over a longer time horizon, has been much more than 2% in both in the U.S. and around the world. It's come down quite a bit. So part of it is a change in inflation expectations. And so I don't want to put too much emphasis on the inversion of the yield curve itself, but the rapid decline in the long-term rates in the U.S. and elsewhere is suggesting to me that just a concern in the markets that is a bit deeper than has been there before. The stock market moves up and down quite a bit, and so I don't put too much weight on short-term movements in the stock market. Policymakers shouldn't be chasing that, and I think people thinking about the longer-run macro view shouldn't be chasing that. But the bond markets, I think, do take a little bit longer view, and that's what's giving me a little bit of pause now. There's a disconnect. The fundamentals seem to be sound, but that's giving a more negative signal, and so I'm more cautious.
And so just on the unemployment rate, which you alluded to earlier, I think it's 3.6% now. I mean, April, which of course is the lowest, I think, since 1969, which is quite extraordinary. Can it actually go any lower? I mean, people keep saying it can't go any lower, it can't go any lower, and then it does. Where is the natural rate now? And also, where is the inflation that should emerge from this low unemployment rate?
No, for sure. So this is not the standard issue textbook kinds of things, and this is actually, and I see a number of my students here, so I'm delighted to see that. Obviously, that some of the textbook stuff that we're going over are different than the textbook stuff that we're going over, and so it poses a challenge because traditionally, when the unemployment rates would get very low, that would typically be because the Fed or central bank is trying to drive the economy to an unsustainable growth rate. And so then there would be inflation that would come. There would be sort of a move back to a more sustainable level. But I can't really argue that the Fed, because it's been bringing interest rates up, has been driving that. Certainly, it's helped the recovery, and some people argue that that's the only thing. I really don't think it's the only thing. And you can see that this labor market boom is not unique to the U.S. It's happening in other countries, but it's certainly happening here. And I think there are good fundamental reasons for that. I think some of the tax reforms we've had, I think some of the regulatory reforms we've had have helped to increase incentives for investment, increase more rational allocation of capital. I think that's helped to sustain things. You can have very low unemployment rates, and if you have high and low inflation, if you have high productivity growth has not been especially strong. It's been getting stronger, and that's going to be one of the keys to see if these regulatory reforms and tax reforms will lead to the investment that leads to higher productivity growth, to be able to sustain very rapid or high employment growth, low unemployment rates without inflation. That's, of course, one of the questions going forward. So far, we've been able to sustain that. There's no natural barrier to how low unemployment rates can go. There's always going to be some frictional level of unemployment. We're not going to go to zero. So there's no particular stop sign that we can't go to below 4, we can't go below 3.5, or once you get to 3.5, inflation has to move up. There's no necessary connection there. But it is a little bit different than we have seen, and that's one of the things that the Fed is struggling with, because they have an inflation goal of 2%. I think they had been thinking that we'd be pretty close to that with an economy that grew about 3% last year, above the long-term average growth rate that they think of around 2%. And with the unemployment rate so low, I think they'd be expecting a little bit more inflation pressure, but we haven't seen that.
Is it possible that the unemployment rate, I guess a little bit like the bond rates that we mentioned earlier, the underpinnings have changed structurally, and it's not as reliable as it is anymore because of the increase in, the lack of participation, I should say, especially by prime-age males in the workforce. And so you're seeing, and of course it shows through with the relative lack of wage growth at the same time as you have ostensibly what is very low unemployment. So I'm just wondering whether you think that the rate itself is as reliable as it once was as an indicator of tightness?
So I'm always a little bit wary of saying this time is different, because usually once you say that, then things go back to the way they always have been. But certainly we have had very low unemployment rate for quite some time with very little inflation. We do have a very different demographic structure of the U.S. and the U.S. workforce than we once had. As you said, we're having different labor force participation by different groups. We're seeing much more labor force participation than in the past by older workers. People are staying in the labor force longer. Part of that is because people are much healthier, and part of it is because the job mix in the U.S. has changed over the decades. We have far more service sector jobs. It's not kind of backbreaking labor types of things. So it would be much harder for someone in their 70s to do those heavy industry types of jobs. But for service sector jobs, it's much easier. So the job mix has changed. People are healthier, and so I think you're seeing some of. So that's one of the reasons why you're seeing more labor force by participation by older people. As you mentioned, some of the prime age male labor force participation is lower than we have seen in the past, and so. We have these demographic changes, we have these other labor force participation changes that may be affecting things. I don't see why those alone would lead to a difference in the labor market dynamics, but clearly we're seeing somewhat different labor market dynamics than we have seen in the past.
Just turning now to fiscal policy. As an Australian, I'm always struck that in the US, no one seems to care very much about the budget deficit of the federal government. Whereas in Australia, we obsess actually about bringing the federal budget back to surplus. It's a major political issue all the time. But of course, there's a $900 billion deficit this financial year, I think, which actually is equivalent almost in exchange rate terms of the entire Australian economy, just that gap between the expenses. It's always a reminder of how huge the US is. Now, the CBO, of course, has forecast that debt to GDP is going to head to about 90% by 2030. But this doesn't seem to be having any impact on interest rates, as we've just discussed.
Clearly.
So firstly, why is that? Why is there no concern about the creditworthiness of the US? And is all of the growth that we've been discussed basically built on this massive stimulus?
So one thing I just want to mention about Australia is you have a structure that I really wish we had in the US. You have this sort of independent debt office that does monitoring. It's a little bit like the CBO, but with a little bit more teeth. The Congressional Budget Office, but that specifically focuses on debt and deficit issues and issues independent reports. And so there's much more of a focus on debt and deficits in Australia than there is in the US. And I think part of that is structural. Now, why do you have this office? It's not random that you have this. It's because there's a strong political consensus worrying about this. Why do we not have one in the US? Because we don't have that same kind of political consensus. But it's a very interesting watchdog office that I think other countries, not only the U.S., should think about having. So obviously, the U.S. is having no problem borrowing in the markets. As you just mentioned, the 10-year rate keeps dropping, and the 10-year rate is now in the 220s for U.S. government debt. So there are no bond vigilantes out there or strikes by the investors. If anything, it's just the opposite. People are thirsting more securities from the U.S. government. That's good and bad. So I think it is obviously very helpful in the short run because it means less of a burden on taxpayer to finance the operations of the government. But it also means that there's not as much discipline, exactly as you said. The reason that the deficit and debt would get more attention in the U.S. is if interest rates went up, because then the debt service would be much higher, that would be a more significant fraction of the budget, and people would be more concerned about the spending. When you can borrow at such low rates, it's sort of easier to say, well, this is a good time to be borrowing. We should be undertaking these infrastructure projects. We should be undertaking these other sorts of projects. And then the question is, how long can you get away with this? So people had talked about Japan is being having a major fiscal crisis coming 20 years ago, when their debt to GDP ratio was about 70-80%, sort of roughly where we are today in the U.S., and now it's grown to be more than 350%. But Japan has negative 10-year rates, has no problem in doing its borrowing. And so I think a lesson from that is major countries with fiscal institutions that are seen as reasonable, reliable, and sound can push the level of debt up a bit higher without having the bond vigilantes come in. But this is a very small number of countries. The US, Japan, for example, can do that. Argentina isn't able to do that. When they had their problems back when I was at the Council of Economic Advisors in 2001, 2002, when they had their meltdown, when they got to debt to GDP ratio of 40%. And then again in 2018, they had their troubles when their debt to GDP ratio went up between 40 and 50%. So there's no magic number. I think it depends on the country, depends on the institutions. But I think right now people are thinking, well, the U.S. economy has enough capacity to deal with that. We have seen the example of Japan, that they've been able to get to 350% debt to GDP without having the bond vigilantes come in. So the U.S. has more room to run on the fiscal side. But as I said, I'm worried about that because at some point, people will become concerned. At some point, that means interest rates will go up. The cost of financing will go up, and it'll be a difficult problem to deal with. And so I wish we had a little bit more discipline sooner rather than later.
Well, of course, part of the reason why the debt is increasing rapidly is because of the Trump administration's tax cuts that took effect last year. I just wanted to ask you, to what extent can we credit those reforms with the current strength of the US economy?
So this is something, as I made reference to earlier, that we're still working on it. So that's one of the challenges that economists have, is they always need a little bit more data. And so sort of 10 years after the crisis, we're still sort of working through some of the data to really figure out exactly what happened. That's not always so satisfying, but I'm going to give you part of that as the answer. It's still a little bit early, but I think we have seen some revival in productivity growth. We've seen some revival in investment. And that's so the debate was the legislation passed a little bit more than a year ago, was that primarily tax reform, was it primarily a tax cut? And it was primarily a tax cut, that'll give you short-term stimulus, but then things would fall off. It was primarily reform. You should see more investment, and then you should see higher productivity growth that would lead to higher wage growth without overall inflation and higher overall economic growth. So I think we've seen some signs of more investment, some signs of more productivity growth, and I think that has helped to sustain economic growth. That the tax reforms combined with with some of the regulatory reforms, I think, have made the investment process more rational in the U.S. Now, some of the tax changes and the tax cuts were bipartisan. So it was President Obama who had suggested that we need to cut the corporate tax rate, because the corporate tax rate in the U.S., when it was last established 25 years ago, actually more than that, 30 years ago, we were sort of in the middle of the pack of the major countries, the OECD countries. The rest of the world cut their corporate tax rates very significantly, and so that's why there are all these issues about, inversions, companies being bought out so they could have an Irish domicile, so they could reduce their tax rate from 35% in the U.S. to 12% there. That was just crazy, and so and companies like Apple and Microsoft and others were keeping hundreds of billions of dollars offshore. That was just crazy. There's no reason for the tax code to be so anti investment in the U.S. And so, and as I said, some of those tax reforms, those tax cuts, were something that was bipartisan, that the Obama administration had proposed. And I think those are totally reasonable. I think we're seeing some of the benefits of that. Now, how much of the recovery is due to that? It's really hard to suss out, both in the shorter run and longer run, because when we do economic experiments, we always like to hold all the things constant. Well, I'd have to say over the last year or so, not all the things have been constant.
Does it worry you at all, this global trend to shift taxation away from capital on, I suppose, to labour income, given the trends of inequality that we're seeing around the world, not just in the US, but in every country? I mean, it is partly because of this kind of race to the bottom, if you like. I mean, are there any solutions to try to fix that?
Sure. So this is a major challenge. But one of the reasons for doing this, and one of the reasons I think why there was bipartisan support and the ideas that come from the Obama administration. So that's why I want to get away from this. It's like somehow corporate tax cuts are just sort of a right-wing or Republican thing. This was something that the Obama administration had put forward, and for good reason. Because if you want to sustain economic growth and you want to have growth of the labor force as well as productivity growth that will lead to higher wages, you have to have investment. It doesn't happen through redistribution. You can do that. That's a short-run thing. but to have sustained growth of the labor force, sustained growth of wages, and enrichment of a broad swath of the working population of the U.S., you have to have the investment that goes with working so that people can earn more because they can be more productive. And so I think if you didn't do something about the corporate taxes, and investment dwindled in the U.S. and corporations held all their money offshore, you'd have less labor growth, and you'd have less productivity growth. So it's not just an either-or that you cut corporate taxes and suddenly that makes workers worse off. If they're done in a way that encourages more investment, you can actually make the workers better off by reducing taxes on investment and taxes on capital. Obviously, the issue will be over time, what does the balance be between the two? But I want to make that really clear that I think that gets confused in the debate. Cutting corporate taxes in and of itself does not mean that it's bad for workers and can actually help workers over time. But then there are issues of redistribution. There are issues of support for workers. I think that's extremely important. There are longstanding University of Chicago ideas that address these kinds of things. So I know that there's a lot of push for the so-called universal basic income to try to give people money to help people who are facing challenges in putting food on the table for their families. And actually, there's a very interesting book with that title, Give People Money, that the first half of the book is exactly what Milton Friedman and others at University of Chicago talked about, the inefficiencies of the welfare system that we have in the U.S. The way we provide support for people is not to give people money, but to say, well, you get food stamps for this, or you get a subsidy for that, or you get a voucher for, or not a voucher, I wish we had more voucher kinds of things to give people more choice, but it's all very centrally planned and structured for them. This book argues that we should just give people money. We should have a much more efficient system, which is precisely the University of Chicago approach, the Milton Friedman approach, which is we allow people to make the best choices for them. And so if you want to provide support to people with lower income, provide support through letting them make their choices rather than making the choices for them. Now, the second piece of that book was, well, and then we should just give people, I forgot what the number was, something like $30,000 a year, and that'll be about 40% of U.S. GDP, and we'll figure out some way to finance that. Well, that's not very University of Chicago to just say, well, we'll worry about financing 40% of GDP later. But another way of providing this kind of support is through the Earned Income Tax Credit. And so that gives people an incentive to work, whereas the universal basic income would not. And I think a lot of people want to work. I think a lot of self-worth comes through engagement like that. And then effectively what it is it provides subsidies to wages of people at the lower end of the scale. And so it has the right incentive program for people to work. It can provide more funding, more income for people. And so I think that's a much better way to try to address the problem than something like universal basic income. But that idea of that people are working, you're giving them more money, and then the household is choosing how best to allocate it, rather than having the bureaucrats in Washington tell them, this is the amount of food stamps you get, this is the amount of housing subsidy you get, this is the amount of the other things you get. I think that's something that I'm very much on board with. And this person who wrote the book, who is certainly not an acolyte of Milton Friedman, I think would agree with also.
Well, let's just move on to monetary policy now, which of course I know is one of your chief areas of expertise. Now, it's fair to say that the Fed had a massive change of heart over the last 6 months. There was the expectation, I think in December, that there'd be 2 or 3 more rate increases this year, and in fact now people are saying that there may actually be a cut. Does that mean that monetary policy is kind of in crisis? I mean, the Fed hasn't met its inflation target, I think, since 2012, not once, and it's been 7 years now. And this is not just a criticism of the Fed, mind you. You can basically make this criticism of the Reserve Bank of Australia, of the European Central Bank as well. And so my question broadly is the inflation targeting regime, which has been cherished for a long time by central banks since the 1990s, is it breaking down?
I think this is a really important question, and I think to the Fed's credit, it is doing a rethink of its framework. And actually, next week here at the Chicago Fed, they're going to have all the Reserve Bank presidents, all the governors, and a number of academics come in to discuss exactly these issues. Is this structure one that makes sense or not? Now, this is a particular challenge for the Fed because it's only in 2012 that they articulated a formal inflation goal. Other central banks have had this for many years, so it's a little more awkward since they're kind of relatively new to the table of an explicit inflation targeting regime to start to rethink it and then sort of change it. One of the points of having an inflation targeting regime is to try to make expectations really well anchored so that it's clear what the central bank is doing, and then people will believe that, and then act accordingly, whether it's in terms of wage demands or whether it's in terms of companies doing pricing planning. But as you said, they haven't made their targets since they have made it explicit, and that starts to raise some credibility questions of can they do it, how could they do it, and are interest rates too high to achieve that? I think that there are some really fundamental questions about that regime that need to be asked. So I sometimes refer to inflation targeting as faith-based monetary policy, because we have the faith that once the Fed says something like inflation is going to be 2%, that everyone believes it, and that everyone is going to change their behavior to act on it. And to be honest, we actually have no data on that. It makes total sense that could happen, but this is a very important part of behavioral economics that macroeconomists haven't really been that engaged with, which I think we should be much more engaged with. Actually, Richard Thaler, our most recent Nobel laureate, just recently gave a talk in Hong Kong where we have a great new campus. And one of the questions was, well, when you were working on all this stuff, where did you think it was going to have the most traction? And he said he never thought it would have the most traction in finance. He thought it was going to be in macroeconomics. But I think we're still waiting for that. And this inflation targeting regime, I think, is a great illustration of where we could learn a lot by just figuring out, well, what actually changes people's expectation? What are what are the types of statements that make them think, now I believe the Fed is going to do this? So, for example, in Europe, Mario Draghi had his famous phrase back around 2012, said that he deviated from a speech that he was giving. And as you know, central bank officials always read from their speeches, and any deviation from that is big news. If I were still at the Fed, I'd never be talking to you like this. I'd be carefully reading the speech, and if I had deviated, you'd be writing a headline article about Randy didn't use the word yet. And that would be a headline, which actually happened when I was at the Fed. When we introduced the word "yet" into one of our Federal Open Market Committee statements, and there was a FT headline. What do they mean by "yet"? We didn't mean anything by that, but it was seen as a big deal. So one of the things that we really need to do, I think, as the central bank community and economists, is to take these behavioral ideas seriously. What statements really matter? So with Mario Draghi, he deviated from a speech and he said, we will do whatever it takes, and believe you me, it will be enough. That was an incredible turning point. If you look at the data, you see interest rates in Greece, Portugal, Spain plummeted on him saying that. He didn't say what he was going to do. He said, believe you me, it's going to be enough. He didn't say, I'm going to buy assets, I'm going to bring interest rates down to negative territory. The speech had nothing to do with that. He said that, the markets believed him, and that was an enormous turning point. But there are other times where central bank officials say things like a very formal structure, 2% inflation, a very nice explanation of what that is, and that doesn't seem to be believed by the markets, not in terms of execution, not in terms of expectation, etc. We don't understand that piece of it. And then even when you do understand, even when people believe you, do they actually change their behavior? One of my colleagues here, Jane Risen, has done some spectacular work on so-called magical thinking. And so she documents how a lot of people have this kind of superstitious views, or they have views that may not really comport with what we think of as traditional, rational, maximizing agents. And then the interesting thing is she doesn't just document that. She says, okay, she runs these experiments where she shows, she demonstrates to people, well, that really doesn't make any sense. And they go, oh yeah, that doesn't make any sense. I agree with you, but I'm not going to change my behavior. So there are two pieces there. It's one, the Fed has to be believed, and then it has to actually change behavior. And those are two steps in the process that we don't have the data on, and I think it would be really valuable and a first-order thing for central bankers and for macroeconomists and behavioral economists to work together to try to understand what types of statements are credible, and then what type of statements actually change behavior. And that's, I think, what we really need to do to understand how we would change the inflation targeting regime.
Does it worry you at all that central banks are perceived, rightly or wrongly, as increasingly becoming political actors because of the quantitative easing decisions that they make? I mean, of course, some central banks buy bonds, some others even buy corporate bonds. The Reserve Bank of Australia actually now is even thinking about doing quantitative easing as well. So it's certainly taken off around the world. And so the first question I wanted to ask is kind of whether or not you think that some of the rise in populism around the world is partly the fault of central banks, who have bid asset prices up tremendously and increased inequality, and has caused all these political ramifications. And then the second point, will their independence, therefore, be in the next 10, 15 years, be under threat?
So no matter what central banks do, they get the blame. So asset prices are high, that's the central bank's fault because other people are not being rich. If the central banks didn't do anything, asset prices are low, that's the central bank's fault, and we're all poorer for that. So it's very much damned if you do, damned if you don't. I think central banks were motivated not just by trying to reflate asset prices. Of course, we didn't want to have a repeat of what happened in Japan, where housing prices in Tokyo went down by 90%, stayed down by 90% for a decade. The Japanese stock market went down very significantly, stayed down for a very long time. That was not good for recovery in Japan. So I think it is due, at least in part, to sensible central bank policies that whether it's housing assets or equity assets or other types of assets have recovered. I think without the kinds of interventions that central banks did, we would have had something that was much closer to the Great Depression. People often don't remember that after the stock market crashed in 1929, it wasn't until after World War II that the Dow Jones was above where it was in the peak in 29. So that took a very long time. It took more than 15 years for recovery. And so that was sort of a tough period. And that was a time when the central bank, at least the U.S. Fed, did almost nothing. And they were worried about inflation rather than deflation at the time. And so I think it was important for central banks trying to provide that foundation for recovery. And also, one of the reasons that labor markets have recovered around the world, because this is not unique to the U.S., unemployment rates are at very low levels in the U.K., in Europe, and in Japan. We wouldn't see that labor market growth and that job creation without that. So I think it's not the central banks that are to blame. I think we would have even more extreme populism if the economies hadn't recovered. So I think if the central banks had sort of sat by and said, well, it's somebody else's problem, and they'll act like what they did in the 1930s and worry about the potential for inflation, I think we'd be in a much worse situation both politically and much worse economically. I think there are a lot of other forces that have come up. I think one was the crisis itself, undermining confidence in a number of the institutions that we had. I think two, there was a perception that money went to undeserving groups rather than to more deserving groups, and so I think there was some perception of that. But I think countries, let's say a country like Germany, that doesn't have the same kind of income and wealth inequality that the U.S. has, and wasn't hit quite the same way as the crisis was. You've seen a big rise of populism there. So you've seen this in a number of countries where it wasn't quite the same in the U.S. and some of the political responses and government responses weren't the same. So I think there's a bigger thing that's going on that's beyond central banks, and I think just beyond economic issues. And I think it has to do with technology, because this is clearly a worldwide thing. This is happening in Brazil, it's happening in Germany, it's happening in the UK. And I think technology has allowed for a very different way to organize politically. So it's allowed for much easier dissemination of sort of fake news types of things. It's also allowed for the rise of candidates who really haven't spent very much money. I mean, people talk about money in politics, but Donald Trump was way outspent by the Democrats and by Hillary Clinton, and he still won. Bolsonaro in Brazil had been in politics for many, many years, didn't have a lot of money to spend, but he was able to use social media very, very effectively. And I think that's changing the conversation. It's changing the way we organize groups, especially people who feel that they are being left behind. Things used to have to be organized more geographically, and sort of media was much more geographical. You had like the local TV station or the local radio station. Now it can be organized by people's concerns. And they can be all over the country or all over the world and have those. And I think political entrepreneurs and populists have been able to understand that and use that in a way that traditionalists haven't. And so I think I would put more of, I don't want to say it's blame, it's the change, I think, is at least as much due to this very important change in technology and the ability to organize more populist type movements than to just what central banks have done. As I said, and people would be even angrier, and I think you'd even have more political upset if the economy were like what it was in the 1930s, rather than the stronger recovery that the US and many other countries have had today.
Well, just before we take some questions from the audience, let's actually talk about the 2020 presidential candidates, if you like. I think we may as well start with the President Trump. I think betting markets say, at this stage at least, very, very early days, he's kind of likely to be re-elected. Especially true if the 23 opponents get a share of the vote each. But would a re-elected President Trump be a risk in any way to the US economy? Would he act differently? Because it would be his last term, obviously.
So I don't think he would act differently. I think people have very emotional reactions to the president, and so I try to get people to sort of take a deep breath and look at the particulars of the policies, because I think one of his negotiating tactics is to get people very upset, and if you get very emotional and very upset, you're more likely to make a mistake in negotiation. And so he's someone who actually understands that very well. Now, that is a very risky strategy in politics, where things have tended to be very incremental, very slow. But I think one of the reasons that the president was elected was because people didn't want incrementalism anymore. I think Hillary Clinton had represented kind of a continuation of the way things have always been, sort of the Clinton dynasty, the way things had just been structured, and people felt they weren't getting what they wanted out of it. So I think they wanted to take a chance, and I think that's part of the same thing with the support for Brexit, for some of the populists in Europe and elsewhere. People feel that they've been hearing the same line for years, and they really haven't felt that they've been getting much. So they're willing to take more risks. And I think the president is a risk taker in his negotiating strategies, but I think he's also had a number of successes in that. I think he's changed the world conversation on China. Now everyone talks about China with respect to concerns about intellectual property. That wasn't true 3 years ago. That now is very, very different. I think he's focused on a number of concerns in the Middle East. He's engaged with North Korea. We'll see if that's going to pay off. It may or may not pay off, but there's more engagement than we've seen in the past. And so I don't think the president would actually act all that much differently in the second term. I think he would want to do more of the kind of what he perceives as pro-market regulatory reforms that he has done. I think he would want to see more of the kind of tax reforms that he has done, and I think he'd want to see more infrastructure spending, and I think he's frustrated that he hasn't been able to do that. So I don't see that it would be some sort of U-turn, but I think there would be continuing risks on a lot of the international issues, the trade issues and such. But I think he would say, we'd made no progress for a long time. We need to do these things, and obviously there's some risk associated with them, but if you don't take any risk, you don't get any gain.
And so just on the trade and the tariffs issue, of course, we saw last week, I think, the third or fourth round of tariff increases on Chinese imports. Do you see that then as just a means to an end, if you like, basically to change Chinese behaviour and you know, whatever the economic costs, it's probably worth it?
And so, so that's a real question about, so I think the way we were approaching things, and I was also part of this. So I was there in the Bush administration when we were, bringing China into the World Trade Organization. Our view was that was the best way to sort of bring China into kind of the Western fold, the Western approach to things. And this had worked with Japan. So if you go back 40 years, Japan was the China of its day, world's second largest economy, growing really rapidly, had this very high savings rate, going to take over the economic activity, and so we all had to learn Japanese, etc. I'm turning Japanese. I really think so. That's an old song. You guys are probably too young to remember that. I'm old enough to remember that. And what happened with Japan is, and also people forget that Japan was not enforcing intellectual property. There were an enormous number of lawsuits, and lawsuits that were lost. There was a big lawsuit with Casio that was lost because they were copying U.S. technology. So it was exactly the same kinds of things, but then Japan was brought into a lot of the international agreements, and as the Japanese economy developed and they were doing more innovation, they've now become very staunch intellectual property enforcers. And so we were thinking China was going to evolve in that way. And I think that's wrong for two reasons. One, there's a fundamental difference in the Chinese regime than in the Japanese regime. And so it's fundamentally different to be dealing with the Communist Party in China than it is to be dealing with a democracy in Japan. And second, it goes back to technology. So for Japan to be able to boom, they had to be able to sell things around the world, sell cars, manufacture them. So Japan is a large economy, but it's only 125 million people. China is 10 times larger. And what is the key thing in business today? It's data. And so the Chinese have data on more than 1 billion people that can be used in technology for trying to build AI platforms, for trying to move a lot of technology ahead. And so obviously China wants to be engaged with the rest of the world, but they can make a lot of progress without as much engagement with the rest of the world. Japan wasn't able to do that. And so I think technology makes things very, very different. That scale that China has allows them to have a lot more kind of do it their own way rather than do it the way that everybody else does it because of technology. And so I think there was a false analogy with Japan. And that's why I think trying to address these issues sooner than later is important. There's a big question about whether using trade issues to try to get intellectual property is the most effective. I think the president feels that this is really the only lever that we have, or the best lever that he has, and we'll have to see whether it works or not. I think the jury is still out, obviously, on that, but it's something that, it's one of these higher risk strategies, but the old stuff wasn't working, and I think just trying to bring China into the World Trade Organization as it was not going to, it did not succeed in making China like Japan, and I don't think will going forward.
Well, just one more question before we go to questions from the audience. On the Democratic side now there are so many candidates. So first I wanted to ask you, does anyone really jump out for you, or do any policies from that side really jump out for you as being a threat or as being a good thing for the US economy? And if a far left candidate were elected, such as Bernie Sanders, would that matter for the economy?
So it very much depends on what happens with Congress. And so if you have one of the houses of Congress, so let's say there would be a candidate much further to the left who comes in as president. If both houses of Congress are with the president, then there's a lot more change that can happen. If you have a divided Congress, then it's much less likely that you'd be able to get that. And so I think there's a real question about whether the Senate would go to the Democrats or not. I think that's not at all clear. And so that would make an enormous difference on how much of a change there would be if there would be sort of further left candidate coming in. Part of the challenge with 23 candidates is that it's hard for me to clearly understand exactly what the particular policies are that they have. I haven't seen sort of clear differentiating policies. I've seen some like big picture kinds of questions about like Medicare for all, or some that are more kind of slogan type things. But I want to see the substance of it more. So I don't really have a good answer on the particulars yet.
All right. Well, maybe there'll be some good questions on these sort of areas from the audience. Just please raise your hand and fire away.
So I leave it to you guys to choose.
You guys choose.
And make sure to introduce yourself so that everyone knows who you are.
Burr Fonin, thank you for being here.
One of my students.
So my question is, we talk a lot about the continued growth and strength of the United States economy. At the same time, I think you alluded to in your last remarks around Medicare for All, a resurgence in discussion around socialism as a serious alternative to capitalism. Do you have any thoughts on what the root cause of that might be and how that will evolve over time?
Great question, and related to some of the populist question that has come up. I think technology is part of that. I think people have now a different approach to things. So it used to be you always had to pay for stuff that you wanted. That was just the standard way that capitalism worked. Now the way technology works is you don't pay for a lot of stuff. You just kind of get it for free. They're getting your data, so you're actually giving them something that traditionally you weren't aware of, that is valuable to someone. So you actually are paying for it in a way, but you're not paying for it with cash. So I think the way that a lot of people, and especially younger people, are perceiving the way the economy works is dramatically different than the way things have worked for centuries. And so it seems like, well, we can produce stuff for free. And, Google's happy to give us a search engine, or so-and-so's happy to give us this or that. And especially people of younger generations don't seem to worry as much about the loss of privacy. I think older people worry more about that kind of thing. And that's why you have like a very different approach in Europe to that. Because if you come from Eastern Europe, from behind, in the old days, the Iron Curtain, probably a phrase that people don't even know anymore, but with the Soviet Union, or even from for East Germany, you worry a lot about people getting that kind of data on you. And that's why they've moved very differently than the US or Asia on data privacy and data protection, because of that fraught history of government. But I think people are perceiving you can get stuff for free, you can get a lot of good stuff for free, and so what is all this stuff about capitalism? Why do I need to earn a lot of money? Why do I need to pay for stuff? And so I think that's part of what's going on, the change in people's perception of how the market operates, because people are paying implicitly with data, and they're not seeing that. And so I think that's a different experience. I think technology also is different because you get, as I said before, with sort of the populist movements or the revulsion against kind of the mainstream, it's easier to organize that than it ever has been before. And then I think there's a perception of a dramatic increase in inequality, that some people are getting ahead and other people are being left behind. And I think some of that is very real. Like median household income in the U.S. has been sort of stagnating. It has come back. What's interesting is that how the media covers things. Not to complain too much to you, but what I often ask people is, what is median household income in the U.S.? Is it above or below? Has it fallen a lot, or where is it? It's actually at record levels, and it's been growing very rapidly over the last 3 years. No one knows that. I think if I'd asked you, I could have asked for a show of hands, how many people would know that we're at record levels of household median income and have had very, very rapid growth for the last 2 years? No one would know that. Now, that's not an answer, because if you look over the last 20 years, median household income has not grown that much. Sure, it's at the highest level that it's been, but if you were asking people where do they think it would be 20 years from now, it would be higher than it is. And that's part of the frustration that people have. People had higher expectations, and they're not getting that. People are having expectations that that they could get ahead, and they're feeling that there are obstacles to that, and it's more difficult. That I'm not quite sure on that, because I think the data are not necessarily consistent with that. But that is a very clear perception. And getting back to what I was talking about before, perception is extremely important. It's people's behavior and people's understanding comes from that. And so we have to understand that better. And I don't think I understand that part as well. But I do think technology has played a very important role in changing people's view of, well, what's all this stuff about capitalism where you sell stuff for a price? I get so much of what I want for free, and then I can just order on Amazon, and the prices keep coming down on Amazon, so I don't really need that much income. Why should I have to work? Why should I sort of be part of that system that my parents and grandparents were part of? And what did it lead to? It led to the financial crisis, where people lost their houses, people lost their jobs. And I think it's very important for people to try to, for academics and economists and policymakers to explain the underlying forces, that the forces of capitalism are still crucial for generating all the income that people have, for generating the things that are for free, and that it's still crucial for people's well-being.
To what extent will we need transfer programs, even as a support to subsidies like the earned income tax credit, when we consider that many of the people who are poor and need help are involuntarily unemployed?
So for sure, that's a challenge if people can't find employment. Now, fortunately, with the very low unemployment rate that we have, most segments of the population are near or at record levels of employment. The growth of roughly 10 million jobs over the last decade have come disproportionately at the lower end of the spectrum rather than the higher end, in terms of number of jobs, not in terms of income, but in terms of number of jobs. So that has been, I think, a very, very positive thing. And that's happened across Democratic and Republican regimes. I'm not saying that one side should get credit for that or the other. And so there can be other support programs for people who are unable to find work or unable to be employed. And so I wouldn't go quite as far as Friedman had said, or this book had said, just get rid of all the support programs we have. But I think it would be much more effective in trying to do things primarily through income tax credit, try to give people the incentive to work and stay employed, and then provide other support programs for low-income individuals or people who who don't have the wherewithal to be able to get a job.
Hi, Professor. Ben Ruffle, first year. Going off that question, is inequality in and of itself, wealth and income inequality, is it a bad thing and harmful for the economy? I mean, do we need some intervention to correct it, or will it take care of itself?
So actually, there are two questions in there. One, is it harmful? And then, yes or no on that. And then, could intervention actually help on that? So there's always, in a capitalist system, you're always going to have some inequality, because there are going to be some people who are coming up with new ideas, some people who are going to become rich. Sometimes some of that will also be luck, so not everything is perfect. I wish it were just sort of, only based on hard work and only based on new ideas. Also, luck plays a role, good luck and bad luck for people. So it's by no means perfect in that. But there's always going to be some distribution of income, always some income inequality. And so some levels of that I think people are perfectly comfortable with, that not everyone is going to be exactly at the same level. The question is, how much does that start to cause a political backlash to make democracy not function well? And I think we're seeing that in Europe, in some places with some areas of these sort of populist responses. And so you will now have the traditional parties getting 25% of the vote, and populist parties getting roughly around the same, and the populist parties being excluded from coalitions. That's going to make people really angry, because in a democracy, if it's 25% of the population who's electing people, are always getting into the parliament, but never get to have any control over things, that'll make people upset. So if inequality leads to that kind of thing, both a political inequality as well as an economic inequality, I think that's not going to work. That's not going to work very well. The second question is, what policies can be most effective if we do agree that this is this is not a good thing. And in the conversation I was having before, I think there are policies. I think things like earned income tax credit could be very helpful. I think trying to promote entrepreneurship, and that's one of the great things that, having been at Booth for so long, when I got here in 1990, no one ever used the word entrepreneur. That word didn't exist. Now, the Polsky Center is something started here at the business school, now it's throughout the university. And whether I'm in the London campus or the Hong Kong campus, that's what people want to talk about. That's what our students want to talk about. That's what our alums want to talk about. And so I think you want to make sure that whatever you do in providing support for people doesn't harm that entrepreneurial spirit, doesn't disincent that too much. I haven't given you a very concrete solution to it. Hopefully some of the 23 or 24 candidates that will be coming up in 2020 will have a little bit more to say, but I haven't given you a concrete solution. But we just want to make sure that it's not just our goal is to make sure everyone is equal. That's not going to work. We're never going to be able to enforce that. There's always going to be someone who's a better basketball player than I am. There's always going to be someone who's a better baseball player than I am. And people are going to want to see that baseball player or basketball player, and we use the price mechanism to allocate who gets to see that person. And so that person is naturally going to make a lot more money than I'm going to make, and that works.
Hi, my name is Lucy. I'm at the Division of Political Science here. And so one of the candidates I'm going to be working for next year is proposing to raise the minimum wage to $15 federally. Can you talk about what some of the implications would be, especially imposing that in an economy with these kinds of indicators?
So the question, because I'm not sure that the mic was working, the question was raising the minimum wage to $15 an hour across the country. So, well, for much of the country, wages are so at least in cities, most cities in the U.S., wages are already above that. So that's not going to be a binding constraint in major cities. So it would be a bit of a push, but not a dramatic push. It's obviously going to be a much bigger push in areas that are lower income areas that have lower wages on average. So by setting a high federal minimum wage, you're having a differential impact that's going to be more problematic in the sense of disincentives for job creation in some parts of the country than in others. And actually there's been some interesting research that has come out looking at exactly this issue of with increases in minimum wage, unemployment rates for lower skilled workers have been a bit higher in some of those areas. And also there's been migration. People have moved away from some of the areas with higher minimum wages relative to average wages. So there is migration that occurs. So there'll be some unintended consequences, I think, of doing something like that. Second, I think my view is that the minimum wage is not the most effective way to try to help lower income households. A very high proportion of people who work for minimum wage are very young workers who are just getting into the labor force. So it's a lot of middle class kids who are working in fast food, for example. And that's not those are people who don't need subsidies. I think it's an inefficient way to do it. That's why something like the earned income tax credit, I think, is a much more effective way to do that. You wouldn't be giving an earned income tax credit to the son or daughter of a middle class person who's working at McDonald's, but you might the person working next to him or her who is in a low income household. And so I think that's just a much more effective way to do it. I think the goal is a very worthy one, to make sure that people have enough income to be able to put food on the table and have a healthy and prosperous household, regardless of where you are in the spectrum. But I think, at least from my mind, there are a lot of unintended consequences of minimum wage. I think it's not an efficient way to get at it. So I think something like the earned income tax credit is much more effective. But it's also, you have to explain it. It's, $15 an hour minimum wage is a much easier rallying cry. Once you start to explain earned income tax credit, it sounds like you're kind of obfuscating. You don't really care about people. But I think it's a more effective way to do it than minimum wage.
Professor I wanted to go back to the macro view that you had presented at the beginning of the talk and ask you if you had any weak spots that would potentially trigger the next downturn for 2020.
So that's always, if you could tell, what the turning point is going to be, that's then it would be the Kroszner School of Business rather than the Booth School of Business. So I'm far from being able to do that. But I think one of the weak spots are some of the I think Italy and Europe. Because Italy has a lot of debt outstanding. They've actually been issuing more debt because interest rates have come down. But they have a very populist government that isn't that interested in repaying the debt. I think they don't have as much room to run as a country like the U.S. Has. And so I think if there's a concern, let's say the economy does start to slow, then the question is, can Italy repay its debt? How easily can it do that? They've reformed some of the banking system in Italy, but not all of the banking system. And so you have some banks with a lot of Italian government debt. Well, all the banks have a lot of Italian government debt on their balance sheets. A few of the banks that are still relatively weak because they haven't cleaned up their balance sheets. And Italy is very large. It's much larger than Portugal or Greece, both within the Eurozone and in terms of the amount of debt that's outstanding. And so that could be a trigger point for Europe. And so I think that bears monitoring closely. And we can see that markets can turn fairly quickly. Like Argentina in 2017 was the darling of the markets. They issued 100-year dollar-denominated debt, which seemed completely crazy to me. And by 2018, that dollar-denominated debt was trading at like $60 on $100 rather than at $100 because people became very concerned about it. So markets can turn quickly, and so I think that would be one of the areas that I would be worried about. I think there could be unintended consequences of slowdown in China. I think the Chinese are managing the slower growth reasonably well, but if there were sort of a major change there, that has a lot of impact on many emerging markets. That could be another trigger that gets around to raise questions about who is sound and who is not, and then weak countries. Then it would get to something like Turkey, so it wouldn't just be an Argentina kind of thing. Italy could also be in that realm. So that's how I look at it. I don't see right now particular trigger points in the U.S., but they could always be there. And if I knew them, other people in the markets would know them. They probably would be already acting on them. So they probably do exist, but they're just hard to see.
Hi, I'm Luis Simon, an econ PhD. My question is regarding the Fed on the next downturn. What do you think their role will be and the tools they'll use will be, given that they start with a really large balance sheet and start from a relatively lower interest rate?
So for sure. So the Fed's balance sheet before the financial crisis was $800 billion. Today, well, it peaked at $4.5 trillion, and now it's around $4 trillion. It'll probably run off to about $3.75 trillion before they end the runoff program. Interest rates are at 2.25% and 2.5%. In the old days, the short rate probably would have gotten to around 4% or 4.5%, somewhere in that range, before the Fed would have stopped. So obviously, in both cases, there'd be more of a cushion to buy assets. There'd be more of a cushion to reduce rates. I do think that they would. So if things turn south, I think they would first start by cutting interest rates, using the traditional tool as much as possible. I think they would then engage in quantitative easing again. I think they'd be very reluctant to go negative, although the experiences in Europe suggest, and so in the Eurozone, Switzerland, and a number of other countries that have gone negative, that you can have reasonable economic activity even with negative rates. But I think there would be real reluctance to do that. So I think they would rely on those two major forces. And then if there were particular issues that came up, particular vulnerabilities in particular markets, I think they would then revive versions of some of the programs we did while I was there to provide funding to particular flashpoints, to particular problem points in the market. But obviously, there's not as much cushion as there once was to undertake quantitative easing, because it does seem that it has diminishing marginal value, and obviously there's not as much room to cut interest rates.
Hi, Professor Mike Friedman, first year MBA. So one issue that's been coming up more and more as we lead into 2020, and I think that's important to a lot of people hears the student debt crisis, as its student debt is now over $1.5 trillion. And there's been various proposals on the Democratic side from all the way to forgiving student debt. I'm not sure that Donald Trump has laid out a concrete proposal to this point, but on the Republican side, one thought has been maybe creating a securitization for people to invest in student tuition. How much of where do you fall in that spectrum of potential solutions, and how much of that solution needs to be driven by federal government and should be a topic of conversation this next election versus something that should be led by universities and university presidents?
That's a great question. So the question was about the student debt burdens, and so I think what you said at the end is exactly right. I think it's got to be a joint thing. I don't think it can just be an arbitrary thing that someone in Washington waves the magic wand and forgives the debt or restructures the debt without engaging with universities and other organizations where people have taken out a lot of debt. So the student debt is not just for traditional research universities. A lot of it has also been for more professional schools. And that in particular is an area where the debt has been very high relative to the payoff from some of that training. So there's a very large expansion of the program that included a lot more than research universities. And I think that has turned out to be quite problematic because the hoped for returns from going to different trade schools haven't been nearly as high as one had hoped. So I think there are multiple ways to work on that. One, on that particular issue, this actually goes back to something that came out from the Obama's Council of Economic Advisors. We have a lot of restrictions on people being able to become beauticians, to become security guards, to do a lot of things that require these so-called certifications. Of course, you want, obviously for a doctor you want lots of certifications, but for someone to cut your hair, do they really need to go through all these hoops? Does there really need to be effectively a cartelization of the industry? And so there are some states that have a lot of restrictions on that. So we've made it more difficult for people to use their training to then be able to get jobs. And as I said, this is something was an excellent piece that was done by the Obama Council of Economic Advisors, so that we should take some of those barriers down on occupational licensing. So giving more people opportunities to use the skills that they learned in school is, I think, one important thing that's not part of the discussion. People focus on the debt part, but one of the reasons the debt part is so burdensome is because people are not getting the payoff in terms of the jobs. So think about it from that point of view. And so I think that's one piece of it that's missing in the conversation. I think thinking about working these things through with the research universities, with the other trade schools, and the federal government is extremely important to figure out how to do this in a way that is going to get to a useful outcome. So it's always very nice to say, well, let's just forgive the debt, but that's a one-off thing. That doesn't necessarily make people better off if they don't have the skills to move forward. It certainly, I should say it doesn't necessarily make them better off. It doesn't make them better off in the long run. In the short run, obviously, getting rid of the debt is helpful. But in the longer run, you want to make sure that people have the skills to be well engaged in the labor market. And so, thinking about payment schemes that could be related to their success in the labor market is one way of doing things. And certainly, some schools have started to do that in linking financial aid to the types of jobs that people get subsequently. And so if people go into social sector jobs and will get low pay, they then have less a burden that they have to repay. So if they're doing something more with a social purpose. So thinking about those kinds of things, I think being more creative than rather than just looking, here's the number, it's $1.5 trillion, and if we get it down to $1 trillion, then we're better off. I think thinking about it from the other side, how do we make the education they've had more beneficial? How do we get the right incentives for people to work, to earn, to make sure they have good earnings, and that this isn't too burdensome to prevent them from doing those things is extremely important.
I'm wondering if you can speak on the issue of climate change as something that is deeply
So this is an incredible challenge because it's such a longer run issue. And so it's very easy to say, well, there's no sort of short run problem. And politicians tend to be much more short run focused than long run focused. The electoral cycle in Congress is every 2 years. And so for things that are really going to have a major impact, there may be, there are impacts in the short run, but the major impacts that people will see will be much longer run. It's hard to get people to be focused on that. And I think it is something that I think operates probably more effectively at the state and local level than at the federal level, because I think you get a very different political dynamic there. So, for example, the president famously withdrew from the Paris Climate Accords. If you actually look at how the U.S. has been performing, it's actually performed quite well in terms of its global obligations through the Paris Accords, and it's continued to perform well. And that's mainly because it's done at the state level. California, for example, has very strict environmental controls. A number of other states have very strict environmental controls. And so I think the political economy is such that even though it's truly a global problem, it seems that we're in the U.S., we may be able to be more effective in dealing with it with some of the rules that you be able to get through at the state and local level. And as I said, even though we're formally out of the Paris Accords, we are actually looking reasonably good compared with other countries and still fulfilling our obligations on that, even though we're not formally part of that. So I think, even though, as I said, it's truly a global problem, it sort of makes sense to have kind of global consensus on it. I think something like the Paris Accords were not, I think were very good for kind of political theater, but I'm not so sure they were so good in terms of substance, because to get 150 countries to agree to something, it's going to be hard for it to be substantive. But I think at the level of, let's say, California, New York, Illinois, you can get more engagement. You can get more engagement on that and make more progress. But that's more a political economy type of argument that I'm making on that. And I think just empirically, that's what we see. We see.
Any more questions? Oh, yes, one up here.
So make that the last question, because I have to get to class, as many of my students here know.
Question about the gig economy. So we've seen the rise of that, and it's kind of changing the face of the labor force. How do you see that affecting the future and what the implications are?
So it's interesting because there's been a lot of research on this, of the so-called rise of the gig economy, so that everyone is just sort of part-time employed and no one gets benefits and such. And actually some of the earlier work on that has been a bit revised, and there hasn't been as much of a development of just people just getting a series of part-time jobs rather than a richer employment experience. And that's also consistent with what I was saying before in responding to one of the questions, that there's been a lot of growth of jobs at the lower wage part of the spectrum. Not, as I said, wages haven't grown very much there, but in terms of the number of jobs. And so there are benefits that people can have from that. So there's a flexibility that comes with being able to be, an Uber driver for as many hours a day as you choose. If you look, a lot of the Uber drivers have been people who otherwise would have difficulty getting into the labor force, and often people with not a deep skill set or a deep educational background, but they can get in and they can make money and they can save and then provide for their families in an extremely flexible way. So there are positives to that. And as I said, I think it's not that it's there's been a hollowing out of the traditional workforce. I think if you actually look at the more recent data, or the data that's a little bit more complete, it suggests that we haven't had that major transformation. It might come, but just like people have been talking about AI sort of hollowing out all the low-skilled jobs, that certainly hasn't happened in the U.S. or in most other countries, or any other countries that I know of, because as I said, in the U.S. it's been at the lower skill end of the spectrum where we've had disproportionate job growth. It may come, and I think we should be thinking about that, but it hasn't quite come yet.
Okay, that's the last question. Professor, thank you so much for being so generous with your time. Please
Good.
join me in thanking Professor Kroszner.
And thank you. I really appreciate that this has been a joint effort by Booth, Harris, Stigler, and so many others, because this is one of the things that's one of my goals, is for us to work together as a university, not as a series of separate pieces. Thank you so much for coming.